Hi, and welcome to Futures Discovery at John Lothian News. I'm your host, Cortes Draper. And like you, I'm no expert, but on this program, we'll embark on the fascinating world of futures and learn from top professionals in the field. In this episode, we will discuss what a futures contract is and how people and professionals use them in the real world to make money. In order to understand futures contracts, we must first understand futures. A futures is a type of derivative. I know this can sound complex, but don't let this word intimidate you. A derivative is a financial instrument that has its value determined by the price of something else. For example, if this pencil is worth $2 in today's market, a derivative on this pencil would derive its value from that price. As the price of the pencil changes, so does the value of the derivative. A futures contract is a standardized financial agreement to buy or sell an asset, commodities, stocks, currencies, etc., at a predetermined price on a specific date in the future. These contracts are traded on futures exchanges. Futures contracts require margin deposits to cover risk in the market movement, and traders are required to post additional capital, i.e., make a margin call to maintain their futures positions should the market move against them. Unfortunately for our example, a pencil is not traded on an exchange. But in later episodes, we will discuss assets and commodities that are traded as futures. But hypothetically, for our example, I could use a futures contract to buy or go long this pencil at a specified price and date in the future. Let's say I want to buy this pencil for today's price of $2 exactly 1 year from now. I could use the futures contract to do so. I would be considered long one pencil futures contract. If we want to execute this futures contract, there are some important terms we should know before doing so. The underlying asset. The underlying asset is the physical commodity or other financial instrument that the contract encompasses. Futures contracts detail the date, quantity, quality, and place and manner of delivery of the underlying asset. In our case, the underlying asset would be one pencil. Margin call. A margin call demands additional funds be deposited into a margin account to cover potential losses. Failure to meet margin call may result in a broker liquidating a position at a loss. Unlimited losses. Someone who sells short futures contracts is exposed to unlimited losses. There has even been recent cases of traders who bought or were long oil futures who saw prices trade below zero as contracts reached their last trading day. So losses on long positions can exceed the full contract value. Spot price. The spot price is the market price for immediate delivery of the underlying asset. In our case, $2. Last day trading. The last day on which you can trade a futures contract. First notice day. The first day the shorts may make delivery. Expiration date. The expiration date is the time at which contracts settle if it is cash settled. Unlike some financial markets, derivative markets like futures give you the ability to short sell. Short selling in futures trading is a strategy where a trader sells futures contracts they do not currently own with the expectation that the price of the contract will decline in the future. The trader aims to profit from the price difference between the contract selling price and the lower price they can buy it back for, covering the short position later on. To better understand short selling, let's use our pencil example again. Let's say I'm a pencil manufacturer and I'm concerned about pencil prices dropping next school year. I could sell short August 2024 big mechanical pencil futures contracts to lock in my price for next fall's pencils production. Most likely, a speculator would buy those contracts from me. But it could also be someone who needs pencils, like a school or business who's afraid prices are going to rise. That is what makes markets. Differing opinions about future direction of prices. Let's say I sold my August 2024 big mechanical futures contracts at $2. And at some point in the future, when prices declined to $1 and I didn't think they were going to go much lower, or I had sales to deliver to clients, I could buy back my futures contracts. If I sold at $2 and bought at $1, I would have protected myself from a decline of $1. When I sell actual pencils in August of 2024 at the price of $1, I will have actually realized $2 per pencil because of my timely hedge. It's important to note that this entire process usually takes place behind a computer screen at a much faster rate. In the futures market, we can also take a long position, which means we are the buyer in the market. If we were a school that was concerned about the price of pencils rising, I could hedge that risk by buying an August 2024 big mechanical pencil contract. Or if I were a speculator and I noticed there was a large increase in number of children registering for school, I might want to go long pencil futures in order to profit from the rise in pencil future prices as demand increases for pencils going into the fall school season. The payoff for a long or short is the value of the position at the point at which we exit prior to the final trading day or expiration of the futures contract. Each futures contract that is listed on an exchange has a month it goes into delivery or is cash settled. Each contract then is referred to by its month. For example, the August 2024 big mechanical pencil mentioned earlier. If August 2024 big mechanical pencil contract is physically delivered, we'll deal with cash settled another day, then there will be a first notice day for the contract prior to the final trading day. During this delivery period, and only during this delivery period, on or after the first notice day, may the shorts deliver to the longs. That means if I had bought an August 2024 big mechanical pencil futures and held it to its first notice day, a short that had made a delivery could be assigned to me depending on how old my long position was. If I was holding the oldest long position, I would receive the first delivered short contract. The next day, I could sell an August 2024 big mechanical futures contract and then retender the delivery, exiting my position in pencils once and for all. However, the best solution is always to exit your position prior to the first notice day, the first day that shorts can deliver, so that you are not involved in the delivery process. Liquidity, or the number of buyers and sellers participating in a specific futures contract month, tends to dry up as delivery approaches because many traders are smart enough to know that they do not want to deal with physical delivery. Delivery is for the legitimate hedgers and users of the underlying product upon which the derivative futures contract is based. Industry professionals use futures contracts for a multitude of reasons: risk management and hedging, speculation, reduced transaction costs, and regulatory arbitrage. Let's now talk to Joe Ferraro, president of MIAX Futures and the leading professional in futures markets, to help us understand better how we can use these contracts to make money and hedge risk. For our interview with Joe and much more, visit johnlothiannews.com.